presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and welcome to the Compact Market Wrap Weekly Update for May the 19th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President at Compact Asset Management. Thank you for joining us today. First, housekeeping note, click on the subscribe button so whenever I post an update, you'll be updated and you can watch it, listen to it at your convenience. Also, if you like to look at all the charts that I'm going to talk about today, go to compact.com, click on Insights, and the YouTube update is there so you can see exactly the charts, the support, the resistance area, the targets that I'm talking about. All of that is free. Just click on the subscribe button. Also, if you need help with your portfolio, give us a call, 800-388-9700. That's the old-fashioned way. Or you can send us an email, invest@compact.com. Pretty soon you'll just have to think about it and AI will contact us for you. No, that's, I think, a couple of days away before AI starts reading our thoughts. But anyways, let's move forward, see the markets. Markets had a okay week, sort of sideways, quiet, not much going on with the markets.
Yeah, I mean, markets have been on a tear recently. Took a little bit of breather last week. S&P up just very little at 0.17%. Dow down a little bit, 0.11. Russell took a little bit of a hit last week, down 2.34%. EFA down 1.5%, emerging markets down 2.45%, and then the NASDAQ flat. So I think the big market mover, kind of market news last week was the inflation data. And clearly that's affected interest rates. And so we need to talk about that, unpack that. And we have some pretty good charts this week talking about, okay, what is the potential future around inflation? What are we thinking? What are these interest rates? Why are they going up? We're going to discuss that today on the market update.
And that's a big deal. Interest rates going up breaking out above the previous high, the highest in a year that we are seeing. What does that mean for the market?
Well, typically when we see interest rates go up, the last time we saw a big increase in interest rates was, of course, 2022, with basically the quantitative easing and all the free money that was created during COVID. That increased the money supply dramatically and caused inflation. And so then you had a lot of dollars chasing very few goods and prices went up all the way to 9% inflation there in 2022. That caused interest rates to spike. And usually you see the stock market come down.
Right.
When interest rates go up, the stock market comes down
not because of massive stimulus, massive printing of money that we're seeing interest rates go up.
Well, I think that's why this time the market, even though interest rates have risen and pretty substantially now over the last, let's say, 2 months, has not necessarily corrected substantially because there isn't this money printing. You look at the money supply, it's actually below average in terms of how much money is being created. The Fed is actually kind of reducing through quantitative tightening. They're actually reducing, the money supply is increasing, but not at 6%. It's increasing right now at like 1%. So relative to history, that's a little bit tight. So even though the Fed has cut interest rates, they still have kind of kept a lid on the money supply, and that's still keeping, I think, inflation in check. And that's why the market is kind of saying, okay, we are seeing some rise in interest rates, but for the most part, I think the market is feeling that this rise in interest rates is somewhat temporary. And we'll talk about why that might be.
Let's unpack that a little bit more because I don't think it is because of money printing this time that interest rates are going up.
Correct.
It is inflation, and inflation is happening because of the Iran war, because of oil prices going up.
Absolutely. We've seen oil prices go up dramatically. And the thing with oil is that it's not just a commodity, but it's a commodity used to transport a lot of other goods, right? So when you raise the cost of basically transportation, which is oil prices, that can then bleed through to the rest of goods and even services as people, they got to drive around and they got to go to whatever, if they're making goods or if they're providing a service, they still got to usually drive to go do it.
Right.
And so then oil is unique in that when you do see any sort of supply shock or oil prices go up, that can definitely have an impact on inflation. But for the most part, the market seems like, I think they're just getting, comfortable with the Strait of Hormuz being closed. We're going to look at the DBO chart, which is tracking the energy futures or oil futures. That's continued to go up.
Right.
I think it's, as we talked about a couple of market wraps a couple of months ago, I think the break-even point where it's just oil prices going too much up, where it's just too much to handle, is around 5% on gasoline prices across the nation. Right now we're at $5. Sorry,
Oh, okay.
$5
Okay.
versus $4.50. We're at $4.50 per gallon around the nation. Sorry, Californians, you're at $6 plus. But I think that the break even on all of these tax refunds that we've gotten from the tax rebates, everyone's enjoying those. Hopefully they filed their taxes on time. They've gotten a nice little rebate here. That is all offset around $5 per gallon on oil prices. So if we hit that point, I think then it starts to bite into the consumption and the spending from the consumer, and then we can kind of see things, slow down a little bit and potentially see a bigger pullback in the stock market.
Let's look at this. Energy was the best sector last week, up 7% last week.
Yeah.
Consumer discretionary, on the other hand, that's just services and goods and small businesses and people going and doing stuff. Worst sector.
Yeah, I think energy, clearly it's just a function of oil.
Right.
The more oil prices go up, and you got to even dive into it. You look at Chevron, you look at Exxon, they're somewhat exposed because they get a lot of their oil actually from the Middle East as well. They have a lot of drilling there. So if the Strait of Hormuz is closed, they might not quite benefit as much. I was looking at an article from The Economist, was also talking about BP, and they have all these trading desks. So you have to get in. But I think if you're going to play the energy play, you can just buy the energy sector. One of the interesting sectors I think is the most kind of head scratching for me is the financials.
Yep.
Financials are down 6% this year, which is a little bit surprising given the fact that now we're starting to see a little bit of a steeper yield curve, right? Interest rates are going up. The Fed is not necessarily going to raise interest rates, so they're able to keep their cost of capital really low from the Fed and then lend it out at higher rates. There's not a huge amount of lending happening. Housing markets kind of slowed down, particularly as interest rates go up. Things really slow down in the housing market. But I do feel like the financials them being down 6% isn't necessarily in line with still the underlying healthiness that we're seeing from the economy. Potentially could be a little bit of an opportunity there if I was looking to kind of value pick.
Yeah, that doesn't make sense why the financials are down as much, especially with their spreads going higher, where they can borrow money much cheaper, lend it higher, so they make more money. We'll have to wait and see.
I think it's just something to watch here over the next couple of months and weeks is if financial kind of rebounds. If you're kind of looking where to put new capital, I wouldn't necessarily be throwing it in the AI trade and the DRAM or even emerging markets for that regard at this juncture, just because emerging markets have a lot of exposure to Samsung, SK, and Taiwan Semiconductor. I think you got to look at a little bit more of the value sectors. And so healthcare, financials, clearly they're down for the year. That might be where you want to add a little bit.
Oil continues to move higher. Again, no clear solution to the Straits of Hormuz right now. Everybody's talking about it, but I don't think President said he was ready to strike Iran again, stop that, because again, if this thing explodes again, I think it could be a much bigger explosion this time around affecting oil, because I think Iran is going to strike back. They can't strike back at the United States, but they're going to strike back at all the Gulf countries and their infrastructure.
Yeah, I think it's really posturing from the administration. It's already kind of a quagmire, in terms of they're seeing inflation hasn't really worked out. I think for them, they haven't gotten any concessions out of Iran. Yeah, they've knocked out some of their power, but has there been any regime change or anything like that? Russia's now potentially getting more involved with Iran, so it just gets more complicated from here. I think if the U.S. escalates, then Iran is going to escalate, and then you're going to see even more of an impact from the situation. So I think we're very much in a stalemate situation. You can see here on the chart, gasoline's at $4.50. I think that kind of continues to creep higher. The administration, I think, is trying to talk a big game to try to get the Iranians to maybe make some changes, but they're not. I don't think that anything's changing anytime soon. Going forward, particularly because Iran is now starting to pivot away from the Strait of Hormuz themselves. They're starting to look at Iraq, they're looking at Turkey, and they're even looking towards Pakistan, all their landlocked neighbors to potentially start to try to transport this oil, not through pipelines. Pipelines take 5 years to make, but getting some of those tankers and all of those things going to still
Yeah,
transport
they're
those
looking at
oil.
alternatives, how to get goods in for their population, and they're looking at the Caspian Sea ports and the Caspian Sea land routes, and they're looking at another port that is next to Pakistan, which is outside of in the Persian Gulf or Arabian Sea, not the Persian Gulf, where they can bring in stuff and then ship it through land lines. So again, I think Iran is the one that is sitting there. They are the ones that are at this point. Time is on their side. The longer this goes on, the longer the Straits of Hormuz is closed.
I think I don't think I think it's a lose-lose. I think the Iranian people, the economy is suffering. They're losing.
Dramatically,
I
yeah.
think the U.S. is losing. Europe, everyone's losing in this situation. So, but the problem is that no one necessarily wants to capitulate to the other side, because then they're going to lose some leverage, in the long run. So that's the recipe, for my opinion, for a stalemate type of situation. We have this new status quo, which has wiped off 20% of oil supply in the globe that's not able to kind of easily get through the Strait of Hormuz. So we're just going to have to continue to deal with it. Once again, it's not. Fortunately, you have all this AI investment. It's still the stock market's not necessarily as sensitive to oil prices as it used to be. So that's still moving forward. So it's masking, I think, the disruption. But it is a precarious situation, and for whatever reason, if there is an escalation, somehow they want to shut down the Red Sea as well. That transport by potentially hitting some targets in Saudi Arabia on the other side of Saudi Arabia, that could be extremely disruptive. So I think it doesn't necessarily get better. It doesn't hopefully get worse. It's just kind of the same. And that's why we're seeing, I think, rates continue to go higher here going forward. But that said, I don't know if oil prices necessarily continue to drive the inflation picture long term, and that's some of the charts of the week.
Yeah, because what we might see is a slowdown in consumption.
Correct.
The people, say, wait a minute, I can't afford $6 gasoline. That's it. I'm going to drive less, and that brings down consumption, and that also slows down the economy.
Yeah, but that's not what's fueling the economy.
Yeah, that's
What's
it.
fueling the economy is tech
AI.
companies and AI building data centers. So that's not really somewhat affected by that piece. I mean, the whole driver of the economy today is AI. So as long as the AI story is still in play, the economy, to a certain degree, doesn't matter. Now, it's important to monitor, I think, that AI really closely. And we'll talk about interest rates here in a second on the YouTube, but I think I just want to give our Market Wrap listeners some of the proxies that I'm watching in terms of the AI trade. And I think there's three.
Okay.
In terms of, number one, I mean, you can just look at the semiconductors, the chips. So you can look at an ETF like SOX. So that's all the chip companies, we're talking NVIDIA, Broadcom, all of that. So that's infrastructure that goes into the data centers. Now we're even seeing the memory chips have exploded. So that's DRAM is an ETF, DRAM is the other component. So you want to watch those two as kind of the infrastructure play around AI. If those ETFs sell off dramatically, then potentially the market says, okay, we've kind of reached our point, we're coming back. The other two that I think are just important is just to understand the valuations around both the hyperscalers and investors in a lot of this AI, in private AI. And my two best proxies for that are Oracle. Oracle is one of the hyperscalers, but they're also the most leveraged. So whenever you're trying to figure out a canary in the coal mine, you're always looking at which company is doing what everyone else is doing, but they're doing it with the most leverage, and that's Oracle. So I think you got to watch Oracle stock. It's already corrected a lot, but if it starts breaking some lows, that would be a warning sign that the AI trade's coming to an end. The other stock that I think is just as important is SoftBank. SoftBank, who knows about SoftBank? This is portfolio manager's son. He's in Japan. They invested a tremendous amount of money in OpenAI, Anthropic. Basically it's a leveraged AI play, SoftBank. And it went up a lot. They did a stock split towards the end of last year, but I think that's a really important stock to also watch, because it's not only AI, it's leveraged AI. They actually took a bridge loan, about $40 billion, to invest in AI a couple years ago. That bridge loan comes due in March of next year. So basically, if OpenAI doesn't go IPO before March of next year, SoftBank is basically somewhat bankrupt. That's how leveraged they are, right? And so they've basically borrowed money to invest in the AI. A lot of people are just putting their hard-earned cash investing in AI. They're borrowing money to invest in AI. So once again, Oracle, SoftBank, and then some of the components of the infrastructure trade, these are kind of indicators or proxies. It's not direct. It's not kind of perfect understanding of what the bull market is ending or what we're looking at. But I think those are going to be some very key indicators that we're monitoring here in the investment committee at Compaq to really understand how much fuel we still have in the tank with this AI investment.
That's a good way to look at it, where you can look at the proxies just like we look at the high yield for the overall
For the
market.
economy, we look at DBO for the energy market and the situation in Iran, et cetera. So then just talking about interest rates. So bonds were down a good amount last week. Luckily, high yield has been outperforming. CPI came out 3.8% year over year. PPI came out 6% year over year. So we've seen some rather big changes. Basically now the Fed funds rate is maybe potentially expected to increase.
Instead of go down by the end of the year.
Yeah. And I think this is important to understand because I heard this is an old, you hear all these kind of taglines about the stock market. I know you know them all. You've been investing in clients' money for 40 years. But bull markets don't die of old age. They die because of a tightening Fed. And as soon as the Fed has the cycle's gotten too high, it's gotten too hot, and the Fed really needs to pull back the liquidity and the reins, that's the end of the bull market. Now, right now it seems like the Fed might have to raise rates 1 or 2 times. That's what we're getting priced in on the 2-year Treasury. It's not maybe the end game, but I get a little worried.
But isn't that what Kevin Warsh is not supposed to do? He's supposed to bring interest rates down. That's why he was put in there. That's his job, to lower interest rates.
There's what you want, and then there's reality.
And reality is tough, folks, because inflation is going up. Cutting interest rates is not on the table now. People are talking more about how many interest rate increases we get and when they will happen. I again think they've gone from one extreme where everybody's expecting
3 rate cuts.
Yeah, 3 rate cuts, and now everybody's saying, oh, we're going to get 1, 2 interest rate increases. I don't think we get any. I think the Fed stays where it is, and it does more QT, which is not something that's announced. Nobody knows most of the time what QT is. And that's really tightening interest rates, but not announcing it.
Yeah, reducing the money supply.
Exactly. They just drain money out of the system. Slowly, very slowly, but they drain money out of the system, and it has the same impact as raising interest rates. You can see the 10-year jump 21 basis points.
Yeah, so we'll look at the chart. I mean,
it's just a huge explosion.
It was a big gap up. So the market, and like I said, I think the market is starting to. Short term, it's not really worried about rates going to, I think, 5, 6, 7%. But I think the Strait of Hormuz situation potentially is now looking at a longer tail, and just kind of longer term inflation expectations are starting to rise a little bit. Not a lot, just a little bit. And so then that's going to ultimately be reflected in the 10-year Treasury. And that gets a little dicey for the stock market because the more these rates go up, I think the more attractive it makes bonds look. Right, relative to the stock market. And as we've said, almost ad nauseum, I said, don't start to think about bonds. Maybe slowly start dollar cost averaging in. And now, particularly that we've seen this big jump in rates, now you want to continue to dollar cost average into those bonds, build that safety bucket, because now you're getting paid almost 5. We look at U.S. corporates. I think the yield right now is 5.3. So you can buy investment grade corporate debt and get paid 5.5%. You get high, and you not have to worry about a lot of things. So I think that makes a lot of sense here going forward.
But there's positive signs. Governments were down 1.14, high yield only down 0.49.
Yeah, so absolutely. So we're not getting that recessionary bond indicator signal. It's just saying, and this is what we've seen almost ad nauseum with any sort of rise in interest rates. It can be painful if you're a bond holder. You have really long duration. It can be painful if you're a stock investor, but it hasn't been painful yet. Maybe that pain's yet to come. But they've all been somewhat buying opportunities whenever that pain did come. So I think we'll continue to navigate that. But we do have those ingredients, it seems like, maybe for maybe a short-term correction going forward. So we'll talk about that in the technical charts.
You can see the shelter, we've talked about it in 22, how it was up here, and we said it's going to come down slowly.
Yeah, so
It's
we're
very slow.
So this is our chart of the week for all the podcast listeners. So we're looking at shelter inflation. So this is housing, which is the huge component of inflation. And when this kind of goes up and goes down, it tends to go up and down, in a trend. And so we've seen both rents coming down since basically made a high in early 2023, and then basically that continues to feed into the CPI. What we also see is we can look at Zillow, and there it's kind of more of a real kind of market indicator. And so those rents have been look here at the chart, around 3%, going back to around middle of 2024. Right now, the rents are still kind of running at closer to north of 4%. So that means that potentially we're going to continue to see rents can continue to come down, and that's going to put a downward pressure on the overall CPI number in the kind of the medium, over the next year or so. So that's always a big thing that we're watching. Don't want to see a big increase in that, number going forward, but it doesn't seem like that's in the cards. So that's why I feel like it's a pretty safe bet to maybe be adding a little bit of fixed income here if interest rates are potentially going to moderate here going forward. And then that gets into then what components are we seeing that have also affected inflation just recently over the last year or two, and that's tariffs and energy, and that's our second chart of the week.
That's an interesting chart. It shows the impact of tariffs and the impact of energy.
Correct.
And it shows that the tariffs sort of go away. The effect of tariffs, which was huge this year and the beginning of last year and the beginning of this year, but it just drops off dramatically.
Well, and I think that was a big effect of the Supreme Court ruling.
Right.
Where for the first time we everyone is worried about I think just overall how much potentially, not everyone, but half the population is worried about the executive branch's reach. But that's why we have the three branches of government: Congress, the Senate. Congress, which is the House and the Senate, the Supreme Court, and the executive branch, the White House, to kind of moderate each other. And so the White House was trying to get really aggressive with the tariffs. They put some things in effect, and that we can see by the chart clearly was having some inflationary pressure going forward. But now that the Supreme Court has put that in check, that tariff effect has really kind of diminished here. Now, of course, the White House unilaterally, without Congress, started the conflict in Iran. And so that's also caused an energy kind of, basically, we would see more deflation, if you will, disinflation if it wasn't for the Iranian conflict. But over time, even Goldman is expecting that energy effect or that inflation to slowly, as people adapt to this disruption, for that to come down over a period of time. So you have shelter coming down, less tariff inflation, potentially less energy inflation. I think that's still a question mark, depending on how things happen in the Middle East. So then hopefully we can see interest rates kind of calm down from these levels and continue to come down. I think that's what the market's expecting. Hopefully this is the case. If we see interest rates continue to go higher, or if the Fed says, what, we have all of this disinflation, so we're going to pump it. We're going to cut interest rates.
No.
We're going to come in and create the money supply. We're going to give the president what he really wants. The market's going to be like, okay, that's great, but we're going to jack up interest rates and see how much the market can handle that. So, all of that I think is still yet, particularly because we're coming on a midterm election. And right now it doesn't seem like things are in favor for the Republicans, at least in charge of the House. So they're going to do whatever they can to potentially maybe try to juice this going into the midterm elections, and that would be rate cuts or trying to not curtail QT.
I don't think that is on the cards at this point, with cutting interest rates, but you never know. If they cut interest rates, say, hey, we'll worry about inflation next year, the year after, we don't care. Let's just like we saw after COVID, we pumped trillions of dollars into the economy, which was overdone, and it caused massive inflation.
Yep.
And so who knows? It could be a policy error, but you never know. But it could give a tremendous boost in the short term.
Oh, things will just skyrocket because everyone goes, oh, it's free. Look at this, free money and everything else. But then, then you're baking in maybe.
But it doesn't last. It's like throwing lighter fluid on a barbecue. It goes poof.
Yeah.
It really is a good poof, but it
then
evaporates.
You don't have a lot of fuel to sustain.
Exactly. Yeah. It just evaporates very, very quickly, and that's what I'd be looking at inflation. You talked about it earlier, up 3.8% now. That's just, and retail sales were still up, so the consumer's still spending.
I think the consumer's still spending. They're still, the lower end consumer's borrowing, but the high end consumer, mostly is your baby boomers, right? They're feeling good. Stock market's near all-time highs. They're out spending, and that's what's really driving the majority of that retail sales. So I think those things are kind of tied. The more the stock market continues to go higher, the more it's just kind of self-fulfilling. And that's where it gets a little bit, somewhat dicey, because then if, for whatever reason we do see a big correction in the stock market, you could see a pullback, in that consumption. It can be a self-fulfilling prophecy. So, things are going to be interesting, I think, for the rest of the year, just given where valuations are today. So you just need to be, I think, like we said last week, diversification is really going to help you weather whatever's coming around the corner.
We saw, inflation numbers were the big number last week, initial claims, so no big
This
deal.
week there's not a lot. I mean, Trump and Xi, that didn't really lead to anything. Nvidia's earnings are on Wednesday after the close. I think really that's the only kind of big thing I'm seeing on the agenda this week. So not much.
So now let's go to the charts. We've broken out to the upside. We broke above the targets that we have, about 72. We're at 73.67 today as of the close. Looking at somewhere around now, this becomes a third wave, and we've got a third wave extension. The Fibonacci target is around 7,700 now on the daily charts.
Yeah, I was looking at my dailies. We filled the gap today. It was at 7,336 was the gap from May 8th.
Right.
So we filled that gap from just a little bit a while ago. So I think you fill these gaps, you get a little bit of bounce. But I don't know. I feel like with the interest rates going higher, every market's kind of, I don't think we need another catalyst for maybe some downside, because the earnings expectations are so good.
Right.
So that's going to continue to support the market. We're not getting that recessionary signal from the bond market. But it's been an incredible run here since April. I think maybe we're just going to kind of do a little back end and filling, a little bit sideways kind of movement over the next couple of months as the market just kind of digests, where's the Fed headed, what's the situation in Iran going, all of those different pieces. The market's probably going to take, I think, a little bit of a breather here going forward.
Now this was a target on the upside right here, around 72 to 73 from the third wave. We've broken above it. We're right here now. And the extension of the fifth wave comes out here.
Yeah, it's wild high.
Which is 8,200. That, I don't know. Maybe we see an interest rate cut.
Or they fuel the, yeah. But I think we just got to, if we're headed to 8,200, I don't know if we're headed there in the next 2 months. Yeah, I think now we got to kind of, recharge the batteries a little bit, and then you can make that kind of move higher. And hopefully we get some, who knows, maybe the situation does get better in Iran, going forward.
They get a peace deal.
They get some sort of peace deal, the Strait of Hormuz opens up, oil prices come back down, and then that could be a huge catalyst.
And then everybody starts here. This is the 20-day moving average right here.
And we're looking at the NASDAQ daily chart.
Yep, it's 25,465. It's about 500 points lower. We might see a fourth wave pullback somewhere, and then a fifth wave to the upside. So we'll see. Maybe we get, the fourth waves are usually messy. They go sideways for a period of time, and we could see that right along here. That's what I'm looking at. Extension on this, we broke above this target right here, which was the target from the third wave. Now the target becomes somewhere right around here, which is just below 28,000. So another 2,000 points. But I don't know if we go straight up or just as we go bounce around here for a period of time, right in this range, and then break out once we get a resolution on that. Small cap also pulling back a little bit, support at the 20-day moving average.
Yeah, small caps a little bit more sensitive to interest rates.
Right.
Right. So with the interest rates spiking, that caused that big correction in small cap. But relative wise, I think they're up kind of the most for the year. So small cap value. If you want it, once again along that lines of diversification, if you're heavy in S&P 500 or even the Magnificent Seven, just take a little bit of profits. Put a little bit of it in the rest of the S&P, maybe a little bit of small cap. Just continue to diversify. Same with international as well. With interest rates rising, the dollar rose a lot. But typically, I like to look at potentially making small nibbles into international whenever we see the dollar rise, because then if the dollar's a little overbought and you see the dollar come back down, that can be a boost for international going forward. DBO chart though.
It just keeps going higher and higher and higher.
So what's your target? Are we there, or is this?
No,
kind
this just the target is right here, 24.50.
Yeah,
And
we're sitting at 23.80.
80 today on the close,
Yeah.
so we're very close to it. So hopefully, we don't break out on the weeklies again. It's just been straight up.
Mm-hmm.
I mean, just since the beginning of the war, in February, we've come here. So we're at 23.80 today.
So what are the technicals selling? I know it's very.
It's choppy. It just depends on what happens in Iran. That's really what it is. It's if they get some kind of deal done, we come right back down.
Quickly.
We see an escalation.
It goes even higher.
It goes even higher. That's
Yeah.
it's just
It's hard to handicap. I think,
exactly
from
what's going to
technicals.
happen out of there. 10-year broke out above this high. This is the high we had talked about.
Yep.
Right
That goes
here.
back to May of 2025.
Yep, we broke above it. New highs for the year in interest rates. We gapped higher here, and so but we're looking somewhere around 475 now. But we're at 466.7 today anyway. So
And I don't think we can discount, when you look at interest rates and them rising, yes, it can put pressure on the stock market, but, this is a big but, and I think this is the promise of AI. If AI is going to lead to all this productivity gains, and that, productivity is like the magic sauce for earnings, because you're basically using less resources, but you're getting more economic output, right? And we
Right.
need that. We
Right.
need that with all the baby boomers retiring, aging population around the world, basically except for Africa. The technology is coming at just the right time to continue to potentially allow the growth to continue, even though baby boomers are retiring at a record rate. And so the 10-year could be rising because growth is actually going to be rising here going forward. So you can't discount that. And I think that's important because particularly when we look at the high yield indicator, it's kind of pointing more in that direction, right? It's not saying that this rise in interest rates is necessarily going to decline. And so I have my relative chart here. And you look at high yield, relative to AGG, basically since April, it's been straight up. Now we've seen, HYG has come down recently, but it's not down as much as AGG.
AGG is down a lot more.
AGG is down a lot more. So high yield is still telling us that the rise in interest rates is more potentially of just maybe, hopefully, pricing in some more growth. And
Right.
I think that's the hope. We've seen that.
Not a slowdown in the economy.
We're seeing all the earnings revisions, right, going higher, and the bond market continues to reinforce that. Now, is it going to be gangbusters? I don't know, because the valuations are already high. But I'm just saying, that's why you want to stay invested. Just diversify a little bit, so you're kind of continuing to spread the wealth around. So if in case it does change, because valuations are high, you're not going to get hurt. And you're going to be good to go. But I think overall things are still, looking pretty good. And if they do start to change, we'll definitely let you know here on the update.
So those are our thoughts. Right now, I think a lot depends. We've gotten to a point where the market is fully valued. We've got great earnings that has pushed the market higher. But we do have on the other side the Iran war and the Gulf of Straits of Hormuz, energy prices. All of that, these are moving in different directions. How these things resolve themselves over the next month or so will really depend how we go for the rest of the year. And I think we're starting to reach an inflection point in a lot of these. Either interest rates break out to the upside, we see the war escalate or de-escalate, whatever happens there. And what does Kevin Warsh do with interest rates as the new chair of the Federal Reserve? So I think the next couple of months are going to be rocky back and forth, maybe an upward bias, slight upward bias. I think most of the gains are behind us at this point, and then we see what happens, how these things are resolved. If they're resolved, we've got much higher prices. If we either escalate, the war escalates, gets worse, we come down on a correction. That's the way I'm looking at it right now. Again, if you need help with your portfolio, send us an email at invest@compact.com or give us a call at 800-388-9700, 800-388-9700. Those are our thoughts. Those are our observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compack Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compack Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.